Imagine investing in the artificial intelligence gold rush, not by picking a single winning miner, but by owning the company that sells the most crucial tools of all: the picks, the shovels, and, well, the very land they dig on. Today, we're diving deep into a company making that exact bet: Applied Digital Corporation, trading as APLD. But here's the real question. Is this a visionary pivot into a market with truly generational demand, or is it, a high-stakes gamble on an unproven model, one heavily funded by debt and fueled by an aggressive amount of hype? Stick with us because APLD's future might just be a binary outcome: massive success or significant challenging failure.
That's a perfect setup, yeah. Our mission today is to truly unpack the complex story of Applied Digital. They're an emerging but, let's say, ambitious player in the digital infrastructure space. We're going to scrutinize their strategic transformation, their incredibly ambitious plans, and the financial tightrope they are undoubtedly walking. As of our analysis date, September 11, 2025, APLD's share price closed at $13.91, and we're going to explore what actually drives that valuation, both the hope and the hesitation.
Right. And to give you the clearest, most comprehensive picture, we've structured this deep dive into two distinct parts. First, we'll lay the groundwork with chapters 1 through 3. That covers their business understanding, management evaluation, and a hard look at their financial analysis. Then, in the second part, we'll shift gears. Chapters 4 through 7. We'll explore market sentiment, their ownership structure, a thorough risk assessment, and finally, bring it all together in our conclusion. Let's jump in.
Okay, let's unpack this business. Applied Digital isn't just one thing, right? They're in the midst of a really profound strategic transformation. They design, build, and operate next-generation data centers, but their revenue streams are currently split between a legacy business and a very different future-facing one.
Yeah, and the core of their strategy, what's really compelling, is this profound pivot. You see, they have their legacy data center hosting business. This primarily provides infrastructure for crypto mining. This segment, as of fiscal year 2025, made up the vast majority of their continuing revenue. And get this, one single crypto mining customer accounted for a staggering 93% of that.
Yeah.
93%, wow.
Yeah, but the real story, the future, is their high-performance computing HPC hosting business. This is where they're building specialized high-density data centers specifically for AI and machine learning workloads. Their model here is like a landlord for the digital age, leasing entire facilities for about 15 years to single massive tenants, often what we call AI hyperscalers, think the tech giants who need immense computing power. They even went so far as to divest their cloud services business because it created friction, as they put it, with these very hyperscalers. It signals a clear, almost ruthless strategic choice to become a pure-play infrastructure partner.
Okay, so what does this AI landlord model actually look like on the ground? I mean, we're not talking about consumer-facing apps here.
No, not at all.
They're providing turnkey solutions for crypto hosting, yes, but for AI, they're constructing these truly incredible purpose-built facilities, often featuring proprietary designs like waterless cooling systems. In terms of market position, they have 286 megawatts MW of capacity in crypto, but their future is centered on the Polaris Forge 1 campus in North Dakota, already contracted for 400 MW with CoreWeave, and that has the potential to scale to a full gigawatt.
A gigawatt, yeah. It's massive scale.
And they've even announced plans for an even larger Polaris Forge 2, a $3 billion project. This really speaks to their primary value proposition: delivering speed, scale, and power to a market that desperately needs it. They claim to have cut construction timelines from 24 months down to a remarkably swift 12-14 months, which, in the blistering race for AI compute, that's a massive competitive advantage, right?
Absolutely, if they can actually do it consistently. Now, if we zoom out a bit, APLD is operating right at the convergence of several incredibly powerful trends. The AI-driven data revolution is rapidly transforming the entire data center industry. Power consumption alone is projected to double or even triple by 2030. And AI data centers specifically, growing over 31% annually, it's just explosive. But the biggest constraint, the elephant in the room, is the power bottleneck. In many places, the grid is at capacity, and new transmission lines take years to build.
Years, yeah.
So this makes sustainability and efficiency, like APLD's waterless cooling, not just good for the environment, but economically vital. In terms of competition, they're up against formidable giants like Equinix and Digital Realty, hyperscalers doing self-build, and specialized innovators. What's truly striking, however, is their valuation. Compared to peers like DigitalOcean and VNet Group, APLD's price-to-sales ratio is an exceptionally high 21.21x. This isn't just high, it's valuing APLD almost entirely on its future potential. It's a quintessential story stock where, conviction is everything.
That PS ratio is truly astronomical. It almost feels like any external hurdle could shatter that. What about the regulatory environment, and how hard is it for new players to even get into this game?
That's a critical point. The regulatory environment is indeed becoming a significant factor.
Hmm.
Local communities are increasingly concerned about strain on resources like water and power, and that's leading to zoning restrictions, permitting delays. It slows things down. And on a global scale, U.S. imposed tariffs on electronic components from places like China can directly increase costs and delay projects. It's a real headache. As for barriers to entry, they are immense. We're talking extreme capital intensity. A $3 billion project for Polaris Forge 2, for example, that's no small undertaking.
$3 billion.
Right.
Wow.
Yeah. And power procurement is arguably the single greatest hurdle. It takes years, literally years, to secure gigawatt-scale capacity. Plus, there are significant supply chain and expertise shortages. You need the right people and the right parts. So APLD's potential competitive advantage comes from its strategic site selection in North Dakota, low-cost power, available land, and what we call their power moat, their early success in securing access to gigawatt-scale power resources. That is incredibly difficult for new entrants to replicate.
Given the scale of their ambition, the people behind APLD are absolutely critical. Let's shift our focus now. Chapter 2. Management evaluation. The CEO, Wes Cummins, comes from a finance and technology investing background, right? Not traditional data center ops. What does that mean for how the company is run? What does it tell us about their priorities?
That investor-led style is absolutely a defining characteristic. Several executives also hold senior roles at 272 Capital, which is Cummins' investment firm. It suggests a keen eye on capital markets, strategic positioning, maybe less on the day-to-day operational grind, perhaps. They've certainly demonstrated strategic foresight. Successfully pivoting from crypto to AI, signing those massive long-term lease agreements with CoreWeave, securing hundreds of millions in financing, that's impressive maneuvering. However, there's a significant area of concern, one that definitely clouds their reputation. It's the pattern of heavy insider selling.
Ah, yeah, you mentioned that possibility earlier.
Yes. CEO Wes Cummins, for instance, recently sold 400,000 shares for over $6.1 million. That was September 3, 2025. And records show 8 insider sales with 0 purchases in the last 6 months. 0. This pattern, management team selling shares while simultaneously asking investors for billions to fund a long-term vision, it's a considerable red flag. It really makes you pause and question the alignment of interests.
Yeah, that insider selling is certainly something to flag, especially the zero buys part. So given this backdrop, what does it tell us about where they're actually putting their money? Are they doing share buybacks, paying dividends?
No, Applied Digital's capital allocation is laser-focused on one thing. 100% of capital is being reinvested into organic growth, specifically building those HPC data centers. There's no M&A strategy. As a high-growth, capital-intensive company, they have no history of share buybacks and, perhaps unsurprisingly, pay no dividend. This approach is entirely appropriate for a company at this stage, Investors are essentially betting purely on future capital appreciation. Currently, the return on invested capital, ROIC, is negative. It's medically 3.16% for the trailing 12 months. Now, that's an expected consequence of deploying hundreds of millions into assets that aren't generating revenue yet. But the key question for you as an investor is whether those future returns will truly justify this massive current investment and, frankly, the cash burn.
Okay, let's dig into the numbers then. Chapter 3, financial analysis. Because this is where the rubber really meets the road. Applied Digital truly has a classic high-growth, high-risk profile. The market has given it a multi-billion-dollar valuation, but its current financials, well, they paint a very challenging picture.
The stark contrast here is truly fascinating. Their market cap sits at $3.63 billion, but their trailing 12-month revenue, just $144.19 million, and they are deeply unprofitable. A gross margin of 29.64% looks okay on the surface.
Okay-ish, yeah.
But then you hit an operating margin of negative 27.96% and a net profit margin of a staggering negative 1,960.25%.
Minus 160%. Oof.
Yeah. Now, this isn't entirely surprising for a company in such a heavy investment phase, but it absolutely underlines the significant hurdles to profitability they face. Their debt-to-equity ratio was 1.11. That means they rely more on debt than equity, introducing substantial financial risk. It's a tightrope walk where every financial misstep could be magnified. And their current ratio is 0.77. That's below 1.0, which is a potential warning sign for liquidity. It suggests they might struggle to meet their immediate short-term obligations.
Okay, so revenue growth has been explosive in the past, but has that momentum continued? And what about free cash flow, the lifeblood of any business?
Well, their revenue growth was indeed explosive. over 500% and 146% in prior years, largely thanks to that crypto hosting boom. But for fiscal 2025, that growth slowed dramatically, just 5.5%, as those facilities became fully contracted. The next major inflection point, the big jump, will only come when their HPC data centers finally come online. That's the bet. As for free cash flow, it has been severely and increasingly negative. We're talking negative $797.01 million for the trailing 12 months. That's predominantly due to massive capital expenditures for construction. This company is consuming, not generating cash as it builds for the future. It's digging a deeper hole before it hopes to climb out.
With all these negative financials, how do we even begin to value a company like this? What does its price-to-sales ratio, the astronomical number we mentioned earlier, truly tell us?
This really forces us to confront a fundamental question, right? How do you value a company with negative earnings? You can't use a traditional PE ratio. Their price-to-sales ratio remains exceptionally high at 23.69x. It makes it a stark outlier compared to industry peers. This isn't just high. It screams that the market is valuing APLD almost entirely on its future potential, not its current performance. It is, as we said, the quintessential story stock. If you were to try a discounted cash flow or a DCF analysis, well, it would be highly sensitive to assumptions. Frankly, it produces a very wide range of potential values. You could get anything from significantly below to substantially above the current share price, depending on what you plug in.
So it's almost guesswork based on optimism.
Pretty much. You'd need to assume extremely high initial revenue growth, maybe 50% or more, tapering down over 10 years, justified by that explosive AI data center market growth. And crucially, you'd need a very high discount rate, maybe 12, 15% or even higher, to account for its immense risk profile, which is dramatically reflected in its truly astounding beta of approximately 6.5.
It's 0.5, so it swings 6.5 times more than the market.
Exactly. This is not for the faint of heart. Extremely volatile.
So with those intense financials and that volatility in mind, let's look at market perception. Chapter 4, market sentiment. What does this all mean in terms of how Wall Street is perceiving Applied Digital? Are analysts bullish despite those challenging numbers?
Well, Wall Street's perception, maybe surprisingly to some, is overwhelmingly positive. The consensus rating is a strong buy. 70% of analysts give it that rating, and average price targets range from 16 to 21 towners, suggesting significant upside from the current $13.91. This bullishness is entirely driven by that forward-looking narrative, right? The massive AI infrastructure market and EPLD's strategic positioning within it. And recent news, like those transformative lease agreements with CoreWeave, bringing in an anticipated $11 billion in contracted revenue, that has certainly amplified this positive sentiment. It acts like rocket fuel for optimism.
11 billion contracted. Okay. That's a strong vote of confidence from analysts, almost universally positive. But are there other parts of the market, perhaps the more skeptical corners, betting against them?
Yes. What's truly fascinating here is the stark contrast to that analyst sentiment. While analysts are bullish, a significant portion of the market is betting heavily against APLD. The short interest is extremely high. It's sitting at 25.94% to 27.28% of the free-floating shares.
Wow, over a quarter of the float.
Yes, representing almost $800 million. This creates a classic battleground stock scenario. You have bulls focusing on future potential and bears fixating on financial fragility and execution risks. This high short interest also introduces the potential for a short squeeze, where positive news could force short sellers to buy back shares quickly, leading to a rapid, maybe even irrational price increase. On a technical level, just quickly, the stock is currently trading above both its 50-day and 200-day simple moving averages. Those are generally considered bullish signals for short to medium and long-term trends, respectively.
Okay, interesting dynamics. Let's talk about who's actually holding the shares. Chapter 5, ownership structure. How much of APLD is owned by big institutions, the smart money?
Well, institutional ownership is indeed substantial. It ranges from 52% to 66% of outstanding shares. Firms like Hood River Capital, BlackRock, and Vanguard are listed as top holders. But here's where we see two critical and, frankly, conflicting developments. On one hand, NVIDIA, the undisputed leader in AI hardware, is listed as a major shareholder.
NVIDIA. That is a powerful vote of confidence.
Exactly. It's almost an endorsement from the industry's kingmaker. However, CoreWeave, APLD's single most important customer for its HPC business, sold off its entire equity position as of June 2025.
Wait, CoreWeave sold everything, their main tenant.
Their entire stake, gone. This sends a deeply ambiguous signal, right? They're committed as a tenant, signing that massive lease, yes, but maybe not as an equity holder anymore. It makes you wonder what their internal calculus might have been. What do they see that maybe others don't, or vice versa?
That is confusing. And what about insiders? We discussed their consistent selling in Chapter 2. Does that factor into the overall ownership picture? How much influence do they still have?
Absolutely. Insiders hold a significant stake, somewhere between 6.5% and 8.6%, valued at over $200 million. CEO Wes Cummins is a large individual shareholder. In theory, this level of ownership should align interests with outside investors. But as we noted, the transaction history is heavily dominated by selling. No open market purchases by insiders in the last year. This pattern of one-sided selling remains a significant concern and further complicates the ownership narrative. And overall ownership is quite concentrated. The top 14 shareholders control over 50% of the company. This means a relatively small group has significant influence. If one or two major holders decide to sell, it could put substantial downward pressure on the stock price.
Okay, we've got a much clearer, much more nuanced picture now. Let's look at the absolutely crucial element, the risks. Chapter 6, risk assessment. Using a SWOT framework, what do you see as Applied Digital's biggest strengths right now?
Right. So what really stands out as their strengths are several key points. First, their strategic first-mover advantage in securing that gigawatt-scale power and land in North Dakota. That's huge. Then there's their specialized, purpose-built infrastructure with proprietary waterless cooling that's a distinct technical edge, and of course the incredible visibility from those long-term, 15-year contracted lease agreements totaling $11 billion. That's a serious pipeline, on paper at least. However, this then directly leads us to the weaknesses. Their precarious financial health is paramount. Deep unprofitability, burning hundreds of millions in free cash flow, high debt, current ratio below 1.0, they are very vulnerable. And their extreme customer concentration on CoreWeave for the HPC business. That is an immense risk.
I have to push back on that customer concentration again. With $11 billion in contracted revenue, if it's all tied to one company, how much comfort should investors really take from those numbers? What's the realistic worst-case scenario there?
That's precisely the right question to ask.
Yeah.
Yeah. While the $11 billion looks impressive, it is a huge bet on one counterparty. The worst-case scenario. If CoreWeave were to face significant financial distress, default on its lease, or even just scale back its needs dramatically, it would rip a colossal hole in APLD's projected revenue and stability, especially given its current financial tightrope walk. It highlights just how critical execution and diversification beyond CoreWeave are for APLD's long-term health. It's absolutely vital. And beyond that, there's still significant execution risk. They need to prove they can complete these massive, multi-billion-dollar projects on time and within budget. That's a huge if.
That makes the stakes even clearer. So what does all of this mean for their future potential? And what external challenges are looming over them? What are the opportunities and threats?
Okay, on the opportunity side, the generational demand for AI infrastructure is an undeniable massive tailwind. That's the whole investment thesis, really. Diversifying customers beyond CoreWeave, which management says they're actively working on, would be monumental in de-risking the business. And a potential wheat conversion down the line could significantly lower their cost of capital, making financing easier. That's the longer-term possibility. But the threats are equally significant. Intense competition from well-capitalized giants, that's one. And the rapid technological obsolescence in AI chips and data center design could quickly make their infrastructure outdated or less efficient. On a macroeconomic front, persistently high inflation drives up construction costs, eating into margins they don't really have yet. Rising interest rates are a severe, potentially existential threat for a debt-heavy, capital-intensive business like APLD. They dramatically increase financing costs and accelerate cash burn. And geopolitically, U.S.-imposed tariffs on electronic components from China, those can be 20% to over 100%, directly increase their capital expenditures and threaten their speed to market due to supply chain delays. Any of these could significantly impact their growth trajectory, turning opportunity into, well, a serious obstacle.
Okay, let's bring it all together then. Chapter 7, conclusion. We need to clarify the picture for everyone listening. What's the most compelling argument for Applied Digital? The bull case in its purest form.
The bull case for Applied Digital is powerful and straightforward. They are a pure play investment in the generational build-out of AI infrastructure. That market is seeing explosive secular growth that shows no signs of slowing down. Management has shown, you have to admit, remarkable strategic foresight by securing access to massive, low-cost power, arguably the industry's single most critical resource. This has enabled them to sign those transformative 15-year lease agreements with an astounding $11 billion in future contracted revenue, significantly de-risking their initial investments, at least on paper. And that equity stake taken by NVIDIA, a titan of the AI world, serves as a powerful third-party endorsement. You can't ignore that. So if management can execute on its construction timeline, APLD is uniquely positioned to become a key landlord for the AI era.
Okay, that's the bright side. And what about the bear case? What are the biggest, most undeniable reasons for skepticism that investors need to seriously consider?
The bear case is grounded in the harsh reality of their current financial and operational situation. It's unavoidable. Applied Digital is in a precarious financial position. High debt, that current ratio below 1.0 is signaling liquidity concerns, burning hundreds of millions in cash per year. It's tough. The entire future of its core HPC business rests heavily on a single customer, CoreWeave, creating extreme concentration risk. We keep coming back to that. Plus, there's immense execution risk. They still need to prove they can deliver these unprecedentedly large and complex data centers on time and within budget. And compounding these risks are those troubling signals from insiders' consistent stock sales by the CEO and the complete divestment of shares by their key customer, CoreWeave. For the bears, this is a financially weak and unproven player attempting to tackle an immense challenge in a hyper-competitive and volatile market.
So, given these two very strong, almost diametrically opposed cases, where does that leave us with the valuation? Does that DCF exercise help us narrow down that incredibly wide range at all?
Well, as we discussed, a DCF for APLD is really an exercise in extreme uncertainty. It yields an exceptionally wide range of potential values precisely because of the binary nature of its potential outcome, success or failure, basically. As of September 8, 2025, APLD's share price of $13.91. It doesn't reflect its deeply negative current financial performance at all. Not even close. Instead, it's the market's optimistic pricing of its future potential. It's all priced on hope. An investment in Applied Digital today is unequivocally a high-risk, high-reward proposition. No doubt about it. If the company successfully transitions into a stable, cash-flowing operator of critical AI infrastructure, the upside could be substantial. Truly substantial. However, if it falters in its execution, struggles with its fragile balance sheet, or sees customer relationships sour, the downside is equally severe. There are no current profits or cash flows to provide a valuation floor. Nothing to catch it if it falls. The company is attempting to build a bridge to a very profitable future, but it must first cross a very wide and treacherous chasm of financial and operational risk.
That's quite the tightrope walk, isn't it? A very vivid picture. This deep dive into Applied Digital really makes you wonder about the sheer scale of ambition and the incredible capital required to power the AI future. What other picks and shovels plays might be hiding in plain sight, waiting to be unearthed, or perhaps facing similar existential challenges? It's a fascinating question, and one certainly worth pondering as the AI revolution continues to unfold at, well, breakneck speed. Before we go, don't forget to like and subscribe to the Stock Analytics AI YouTube channel. For just €4.99 a month, members get priority deep dives on tickers. And we'll be covering all of the S&P 500 stocks over the next few months, with members getting exclusive priority access. If you want a one-off deep dive on a specific stock, just drop us a super thanks. We appreciate the support.
And remember, this analysis was generated by an AI system for educational purposes only. It should absolutely not be considered financial advice. Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.